All right, I know you've all been waiting for an insight on Chapter 16, the cash flow statement. What did we read about yesterday? What is the homework that we did? Why is it important? What do we need to know about it? So here's the deal. The cash flow statement is as simple as what you could ever think about. It is just the log of where all the cash went. The statement of cash flows provides you with a spot to make sure you know where all of the money or cash equivalents, which is anything that has the same value and can be readily turned into cash. Where did it go? How was it spent? Where was it used? We do this for a few reasons. Number one is if cash goes missing, it's nice to be able to find it, right? If you are a company that has seasonality, so think about Shine, for example. Shine takes in all of its money when we start to do spring cleanings in May, and then June we're busy, and then in July we're busy, in August we're busy, in September we start to slow down, and then October, November we do Christmas lights and we're really busy. But currently, January and February, we're dead. There's nothing going on. And we might need to say to the bank, we need a loan. And they might say, prove it. Why would we give you a loan? You have $0 in the bank. And you might say, listen, over the last 24 months of my business, here's where all the cash came in. And you can show them through the statement of cash flows, here's what I took in, here was the value, and this is what we anticipate is going to happen the next year. The statement of cash flows is going to focus on three things that I'm sure you already read about and might even be tired of seeing. Now I'm going to put them into context. So you have your operating activities, your investing activities, your financing activities. Those are the three things that the book talks about. When we talk about accounting chapter 2, we're talking about these big, huge companies. And how do they get cash? Well, if it's a big, huge company that's publicly traded, they get cash when they sell shares. They get cash when they make a sale. They get cash when they trade some of the stock that they own in another company. They get cash when they earn interest on anything that they're earning interest on. That's where the cash comes in. If you're talking about operating, that's your everyday thing. That's when cash, it's called a cash outflow, but it's money that you spend. You spend money on paying employees. You spend money on keeping the lights on, paying the utility bills. You pay your taxes, your fines. Those are the things that would be your operating expenses, right? When you buy shirts to sell shirts, that's an operating cash outflow. If you're investing, then you're going to be spending your money on buying assets, buying investments, buying property, plant, or equipment. That's basically anything that you want to grow your business. Those are the investing activities. They're put into a different category because that's just how the cash flow statement is set up. Don't overthink it. That's just the reason why it's set up that way. And then financing activities, especially when you're just into accounting too, the difference between financing and investing is different. What I want you to think about is with financing, these are very focused on your stock, your own company stock. So that's when you pay dividends to shareholders that already own your stock. If you purchase treasury stock, which means you purchase your own stock because you believe that your company is going to grow and gain value. And then if you're going to pay a withdrawal to the owners of the company. So if you're a smaller company like Shine, there's only a group of 6 owners. Whenever we take cash out of the company, we take it all out at the same time. That would be my own company stock, a financing activity where we pay the owners of the company. And the last thing is, if you are focused just on the stock of your company or just on the financing activities of your company, if you want to pay off your debts or if you want to pay off your bonds that you sent out, that is what would also be a financing activity. So financing is stock that deals with your company stock or your long-term or short-term obligations, the chapter 14 stuff we learned about bonds. If it has to do with that, it's financing. If it has to do with buying new stuff, buying stock in other companies, buying long-term investments, that's investing. If it deals with your bond and your stock, then it's financing. What you really want to do at this point is just say, okay, this is simple. And most of what we are doing in chapter 16 is just saying, how do I create this cash flow statement? And cash flow statement is simple. In the direct route, what they do is they say cash from operating, cash from investing, cash from financing, How much cash did I gain? How much did I start with? What's left over? That's the simplest way to look at it. If you want to get any more in depth on it, every company's cash flow statement tells a different story, and it's helpful to just look at one organization and say, oh, I understand your cash flow statement. But if we're doing it as we are in chapter 16, just keep it simple. It's just a map of where the money went. Let me know if that's helpful. Thanks for sticking with me. If all of you saw this 5-minute and 26 video and you watched it all the way to the end, I appreciate you guys. Let me know if you have any questions.